Um, uh, Welcome to our seminar today. I'd just like to commence, as we always do, with an acknowledgement of country, and like to acknowledge the traditional owners of the people on the various lands, and I'm sure there are lots on which we virtually meet today. And I'd like to pass our respects to elders past, present. This is a really cool morning because we get to talk about a technical issue associated with employee ownership. And if you're a wonderful employee ownership nerd, this is really cool. It's even cooler that we've got Marc and Dee, who are real experts in the topic. Marc Bazzotti and I have worked together for a long time. Marc's chair of our peer group, board member at the Alta, and has done lots of this. Dee is at MUFG Corporate Markets and has worked on the coalface of this, and is also involved in our peer group. So is very much, or they're very much the experts on this topic. So really looking forward to hearing about it. Just as a really short thought, it did occur to me today that as a lawyer, I look at things and think about technical compliance, but we were talking about this topic yesterday, and it occurred in many ways that it was actually an opportunity, because it was an opportunity to actually communicate with the employee base and reinforce the relevance of the plan and explain it. So I guess I'm interested in hearing both elements of in a sense, the technical obligation and the opportunity. In terms of today format, Marc and Dee are obviously speaking. If you have questions, please put them in the chat. We will set aside some time at the end for questions. I may interrupt Marc and Dee during the course for some questions. I did want to give you just a little bit of a background on EOA and what we have been doing, both in terms of advocacy and what our plans are for the next little period. We have, and we're about to release a white paper, which is basically a policy paper, a quite detailed policy paper on all of the areas that we've identified as areas for growth. And the overwhelming mantra around it is that in terms of employee ownership, both tax and regulatory systems should promote, not prevent. We would really love to hear from any of you as to the concerns or questions that you've got and things that you would like us to take up in terms of that policy process. Our aim is to engage with the new government and the opposition to seek to really pursue some policy reforms in the area, which I think are very much overdue. Also, I guess I'd like to just perhaps give you a little heads up on what we've been trying to do as an organisation to try and help the various employee ownership communities and connect with you a little better. We've really focused on the fact that employee ownership is not the same for everyone. There are very different communities. There's the listed community, the offshore offering community, and we've looked at that as a group and said, how can we best communicate with you and connect with you? And then we've looked at a startup community where the needs for employee ownership are very different and the issues that are being faced are very different. And we're looking to work with that group as a community. We do then have, in a sense, the unlisted community, which is, in a sense, all other things, which is a little unfair because it includes a vast array. A segment of that is one that is close to our hearts, which is, in a sense, the promotion of employee ownership trusts, which is a very separate and discrete, in a sense, market. But again, they're all segments that we'd like to connect and hear from you. So I guess my overwhelming and core message to you is we'd love to hear more from you. And the more we hear from you, the more we can, I think, help you. So please jump on the wagon and enjoy the ride. So with that, I think I'll pass you first to Marc, and look forward to the presentation.
Okay, thanks very much for that introduction, Andrew, and just good morning, everyone. Marc Bizzotti from Viato Partners, as Andrew mentioned. I thought I'd just quickly share my experience with employee share scheme reporting. Actually dates back to its inception back in 2010, and predominantly a lot of the work that I've done in the employee share scheme reporting space has been with foreign companies that are based or headquartered offshore, that have operations here in Australia, and helping those companies to perform their employee share scheme reporting requirements. So I look forward to sharing a bit about that throughout the session today. I'll turn it to you, Dee.
Thank you, Marc, and thank you, Andrew, for the introduction as well. Good morning, everyone. I really appreciate everyone taking some time out of your day. I have been in the employee share scheme space for over 15 years, and been working with a number of listed, unlisted clients on implementation of their schemes and the administration of those schemes. So certainly been involved in the ESS reporting, again, similar to Marc, from the inception back in 2010, and have been working through all the different changes that have come through for the ATO tax reporting. And we'll be very happy to share some of the insights and information around how all things employee share scheme reporting today. So Marc, thank you. If you could just move to the next one. So just quickly running through the agenda today, and conscious of the fact that there may be listeners or attendees today who have no background in ESS reporting. So we've tried to cover as much information as we can. So providing a bit of a background history of ESS reporting, tax position of some of the most widely used share plans in Australia, and talk about a little bit of nuances around those plans. And then we will talk more around the complexities of having mobile employees, the common questions that we receive around ATO reporting, as well as the common mistakes that clients we have encountered in the past as well. So please feel free to put your questions in the chat as we go through, and we'll certainly want to make this as an engaging session. So moving to the next slide, Marc, thank you. So we thought we'll just start with a bit of a history and a background of ESS ATO reporting. So what's reportable? It's all the plans that fall within the Division 83A of the Income Tax Act are reportable to the ATO by the 14th of August, no later than 14th of August. And there's an obligation for clients or issuers to provide an ESS statement to their employees by 14th of July. Now, this information is also provided to employees as part of their pre-fill, given all the advancements that the ATO has made to their portal now. There has been changes to the ATO reporting or the taxing events requirements since it was introduced back in July 2009. And the couple of key dates where they have made changes is 2015, when the laws changed around taxing event from vesting to exercise. And most recently in July 22, when cessation was removed as the taxing point. So you can probably see the changes don't come through, or ATO does take some time to make those changes, or based on all the consultation. So looking at it, it's like every 5 to 7 years there are some new changes to improve the ESS reporting and improve overall structure of share plans in Australia. So what it means is having those changes has led to a few different regimes of that we need to be conscious of when we are doing the reporting. Now, the 2009 onwards, it's grandfathered. It's quite old now, and it's we've passed the 10 years. So hopefully there is no plans around that have a 15-20 year lifespan. But in particular, if you look at as of today's stage, it's the plans that fall in that 2015 to 30th of June. and the changes that have come in from 1 July 22 are still in play, and there may be awards that have a long vesting dates of 5 years, 4 to 5 years, or even a longer time frame. So just need to be conscious of when looking at the what is the taxing event. Need to consider when were these awards granted, what is the taxing point, and how does that actually impact the reporting in FY25. The only thing, I guess, the difference between the changes is the change they made to the cessation, removing the cessation taxing point. That's based on the termination date or a cessation date of employee, rather than not based on when the award is actually granted. So we'll move to look at the general, I guess, just this is the ATO prescribed ESS statement that's made available to employees. Multiple labels, and depending on the type of scheme and the type of the taxing event it is, we will provide, or the information needs to be provided in the different labels for the tax return. You'll see there are two separate sections for listed or companies that fall within the standard rules versus a startup. So startup companies have slight variation, and the taxing events or the taxing the notification to ATO is then at a different date and time as well. Couple of things here that are quite important, just around reporting. If there are no TFNs provided when the data is lodged with the ATO, there is a withholding obligation on the company. So just need to be mindful of that. The other one, and we will talk more about common mistakes and questions that we get, is just around the authorized person that needs to be noted on the statement as well. So the general rule is the person who ATO can contact or is being authorized by the company as a representative who can discuss matters with the ATO. That's the person who should be named on it. It would align with the person who's noted on the pay-as-you-go end of year statement as well. So we'll just look at some of the moving to the next one, just around some of the common taxing points for the most common plans in Australia. So tax exempt plan, whether it's a salary sacrifice up to $1,000 or it is done as a gift share, most commonly done as a gift share to employees. It's reported upon in the year of grant when it's been allocated to the participants. And the value that needs to be reported is based on the price used to calculate the number of shares that employees will receive. Quite straightforward in terms of that needs to be reported. The nuance here is it's tax exempt for anyone who is earning under $180,000 adjusted taxable income. However, if the individual's taxable income is over 180K, then the tax exemption doesn't apply on the value of these shares, and you need to include this as a tax payable amount in your return. Similar to that's a general plan. We've got salary sacrifice plan. One of the other common plans is providing employees with a tax deferral scheme where employees can contribute up to $5,000 and defer tax on that on those shares. The current rules allow employees to defer tax up to 15 years. Now, that 15 years is a maximum. But every company or issuer can actually decide what's the maximum period they would like to allow employees to defer the tax to. So it can be 7 years, or you can give, or issuers give employees the ability to select a tax deferral period as well. It can be anywhere between 1 to 15 years. So once the shares become unrestricted or they're out of that tax deferral period, that becomes a taxing point. One common thread with deferred share plan and all other non-tax exempt plans is if the shares are sold within the 30 days of the taxing event, then your taxing point moves to the sale date instead of the date the shares are released or exercised or vested. So that's something quite important to keep in mind if you are, completing ATO reporting. If you're aware of that the share sale has been done within 30 days and it's been recorded, then that becomes your taxing event. So the next couple of plans that we look at is your performance rights plan, or it can be STI rights, short-term incentive, long-term incentive rights plan. For those plans, generally, it's again upon the conversion of those rights to shares is your taxing point. 30-day sale if you've sold the shares within the 30 days. Now, we are seeing more and more companies having further restriction after vesting of these rights and being converted to shares. So if there is a further restriction within the plan, that means the employee is not able to trade or transact in those shares. So your taxing point then will move from exercise to the date the shares become unrestricted. Now that restriction needs to be called out at the point of the offer is made to the employees, and it needs to be, it's not an optional for employee to pick and choose that I would like this to be restricted for the next 10 days or 20 days. It needs to be directive from as part of the plan itself. The other thing around those restrictions is also to consider whether the conversion has happened during a trading blackout or a restricted period from a trading policy perspective. If that is the case, again, employee is not able to transact in those shares, and you would move your taxing point from the date the awards have been converted to shares to the date when they are actually able to transact in those shares. So tracking those trading blackouts, restriction periods makes it is important to making sure that the employees are paying tax based on when they are able to actually access those shares. Option plans are very similar in that sense that the employees will either pay tax upon exercise. If they're selling shares within 30 days, it's 30 days. If there's a if they are able to defer, it can be up to 15 years from grant as well. So similar rules apply for option plans. The only difference is if the option plans have an exercise price linked to it, then that is deducted from the value of the shares. So that's a cost that an employee has incurred to receive those shares, and that is deductible from the value of the total discount that employee needs to include in their tax return. If the employees are selling these shares, the cost, incidental costs like the brokerage, admin fee, all those costs are actually deductible from the final discount that employee needs to include in their tax return. So we'll move to the next one, which is quite an interesting one, and that certainly has an impact based on the recent changes to the tax laws and this is around indeterminate rights and the change of laws around the cessation of employment. So we've used an example here where depending on when the employee ceased employment, whether they need to pay tax in the year when they receive the shares, or we need to look at it, they need to pay tax based on the year when they left the company. So a couple of examples here where the first one is around employee terminating before 1 July 22. It's an indeterminate rights plan, and they've received the shares in September 2024, which is FY25. In this case, because they were indeterminate rights, the taxing point is still at cessation. And whilst they've received the shares in September 24, the tax needs to be filed back to, or it needs to be done for FY22. Similar scenario, but if the employee had left after 1 July 22, what it means is the cessation is not a taxing point any longer, and the tax is payable when the employee actually receives the shares. So the employee will be taxed in FY25. You can certainly see, just talking about it, the removal of cessation of employment has made it much more simpler and easier from an employee perspective, from an issuer perspective as well, that you don't have to go and do an amendment to your previous tax return. So that's been a real positive change. So I think we'll move to the next one, where I'll hand it to Marc to talk more about the mobile employees and the challenges in that category.
Yeah. Okay. Yeah. Thank you very much, Dee. And so, yeah, for mobile employees, in terms of employee share scheme reporting, we probably would consider mobile employees to be one of the most difficult categories of employees to have to report for. And it's here that companies do have an option as to how they decide to report for mobile employees. Some of you might be aware for mobile employees, depending on their movement dates and their tax residency status, it may be that not the entire amount is subject to tax and therefore reportable. It may be possible to report only a portion of the gain on exercise, vesting, whatever the case may be, in their tax return, and therefore it's also possible for companies to report that taxable amount to employees. So that's where we sort of talk about this gross or assessable amount is terms of what employers may choose to report. Gross would be that you just report the entire amount, just like treating mobile employees as if they were domestic local employees. Whereas reporting the assessable amount would be to report the amount that actually is taxable to the employee. It generally would be, again, that apportioned amount if that was appropriate. And so we'll touch a little bit more around some of the complexities of mobile employees, but that's sort of when we talk about common mistakes and common questions are asked. But that sort of decision about whether you report gross or assessable, that needs to be indicated on the ESS annual report that the company provides to the ATO. It's not indicated on the statement to employees, but it does need to go on that annual report, and you would indicate that via labeled G or A at the relevant part of the ATO annual report. And if you do decide to report the assessable amount, then you also need to indicate the number of days of overseas employment that related to that particular award. So there's a little bit more sort of complexity around sort of reporting for mobile employees. In terms of whether to report the gross or assessable amount, I think best practice would be to report the assessable amount if that information is known and is available. So that's in terms of understanding what that employee's movement history was, what their tax residency status was at the taxing point, so that you could potentially accurately report the assessable amount. I think the reason why that would be best practice is because obviously employees receive those ESS statements, they use it to help them prepare their tax returns, and that can sort of hopefully help the employee to report more accurately in their tax return, rather than potentially reporting a gross amount when only an apportioned amount was actually taxable to them. But the challenge is that you need to be aware of that information around their movement history, their tax residency status. For some companies that can be difficult to obtain, difficult to verify, and so reporting, I guess, the gross amount, while it may not be providing the employee with the best level of information, is probably then the more conservative approach to take. Dee, I don't know if you had any particular comments on that before moving on.
No, thanks, Marc. I think you're right. So it's quite important, and we do work with a number of clients in a similar space where it's important to know how many days they were in Australia or overseas, and then doing the calculation of the assessable portion of the discount as well. So it is quite important to get that right from an employee perspective, given that they may have a tax implication in multiple jurisdictions.
And I think we'll come back to this later on when we talk about communications to employees. Again, noted that indication of gross or assessable is not required on the employee share scheme statement. It's just required on the annual report to the tax office, which means that you probably want to think about, though, in reporting to employees, how it is communicated as to like what basis has the company prepared the ESS statement. and we'll get to that in a little bit. So we come to this next section around, well, what are some of the common mistakes that we typically see on employee share scheme reporting? And probably the first one probably really follows on from the complexities or the challenges in reporting for mobile employees. And I think, one of the most common reasons that I've seen or had to help companies to amend ESS reporting would be probably to include mobile employees that have been missed in the initial reporting that was performed. And so I think, two categories, I guess, there of mobile employees to watch out for. The first being, those employees that are no longer in Australia at the time of the taxing event, but that they had performed services in Australia during the, that grant to vest period, or the period that's considered the relevant employment period for that award. Because they still will be taxable, that they may no longer be here in Australia, that they may no longer be Australian residents, but to the extent that they've had some service here in Australia that award relates to and is therefore taxable here in Australia, there's a requirement for companies to report that amount to those employees. The second one would probably actually be employees that they are here in Australia, but they've moved here to Australia from somewhere else. But they still, particularly from an equity program systems perspective, may still remain tagged to the home country where they've come from. So again, maybe say someone who's come from the UK who's now here in Australia, they've had a taxing event that's occurred here while they're in Australia, and amounts taxable and reportable here in Australia. But the equity system is kind of still sort of tagging them to the UK. So when you get the data, that employee isn't contained there. So there are a couple of ones to watch out for. Next category is kind of sort of missing transactions. I think this also particularly again applies to companies that have their headquartered outside of Australia. Again, lots of other countries around the world operate on a 31 December tax year end. Obviously here we're on a 30 June tax year end. So it's ensuring that the data that's provided captures our Australian tax year. And that goes all the way then through to 30 June. I know that a number of companies will start planning for this and start preparing their reporting before the end of the tax year, because we don't have a whole lot of time to get the reporting done between 30 June and providing statements to employees on the 14th of July. But it's therefore again making sure that any sort of transactions that may have then occurred, particularly from the time that preparation may have already commenced for doing the ESS reporting, that they're also captured. Incorrect determination of the taxing point. Dee at the very beginning of this presentation, started talking through like what is the taxing point, and I think that's really again a really important thing. It probably sounds a bit obvious, but I think it can sometimes be overlooked in determining, well, what actually is the taxing point for this particular award. ESS reporting basically requires companies to report taxing events to employees and to the tax office, and so I think sometimes some assumptions go into place that everything's taxable at vesting or everything's taxable at exercise, but as Dee sort of went through that, those taxing points can vary. So having a real clear understanding of when that taxing point arises is critical to getting the ESS reporting correct. Termination events for employees. Thankfully, that's been removed for any terminations that occur after 1 July 2022, but still is something to look out for. You may have some transactions during this tax year, some vestings, some exercises, but they relate to an employee that terminated before 1 July 2022, and therefore they should have been reported or picked up in a prior year. So regard still needs to be had for those employees. FX conversions, this might seem like a real simple one, but particularly again for those companies that are listed offshore, the number of times we've seen mistakes happen on around the way the FX conversion is applied. So definitely one to watch out for. And then ensuring that the amounts are reported at the correct part of the employee share scheme statement. Dee flashed up the pro forma ESS statement a couple of slides ago. There's obviously a number of boxes, a number of different labels where you're required to report amounts for different types of awards, depending on where they're taxed, depending what type of company it is. So it's ensuring again that those labels are correctly completed, and that the taxing events that you're looking to report for your employees are disclosed at the right item. Anything else there, or Dee, from your experience that you think that we should make the audience aware of in terms of common mistakes?
Yeah, I think I was just thinking about other nuance that we find is and something doesn't happen all the time, but for a smaller issuer, or where you've got the founders with a large number of equity or shares, there is a nuance around if you are a shareholder that holds 10% or more, then for your awards, you are actually reported at grant rather than upon vesting or exercise and so on. So that is something to remember, and it's not always easy or in front of mind to calculate how what's your total percentage of number of shares that the employee has, and it could potentially build up over year on year, and as a director they may hold a large number of shares. So just a reminder, or another nuance in terms of reporting for to the ATO.
Thanks, Dave. And so we might go on from common mistakes to common questions. And so, one of the ones, particularly, that I found over the years is who's required to submit the ESS reporting, because the ESS reporting sort of talks about that the provider is required to perform the ESS reporting. And this, I think, particularly becomes a question for foreign companies that have entities out here in Australia, or I think also even for Australian listed companies that have multiple entities here and multiple businesses here in Australia. And so really, I think from the ATO's perspective, is that the provider is the entity that actually is issuing the interests, whether that be the shares, rights, options, to employees. And so you would typically see that to be the parent company in which those awards are over the shares in that particular company. So yeah, it's quite fine for the reporting to be done if it is a foreign provider, for the reporting to be performed under that particular entity. Again, even though they might not have an ABN here in Australia, that's still fine. So it's also not necessarily to do the reporting at each entity level. So if you've got multiple subsidiaries or multiple employing entities here in Australia, you don't need to file ESS reporting under each of those entities. You can. I haven't seen the ATO reject any ESS reporting for companies that do decide to break it down on that basis, but there is the ability to simplify the reporting to the tax office and to just have one entity do it. We also can see some circumstances where, again, you might have a foreign provider, a foreign entity that actually uses its Australian entity, its Australian subsidiary, to do the reporting on their behalf. And that's also okay too, because providers can also appoint an agent to perform the reporting on their behalf. And so really, I think, based on experience, the ATO will largely accept the reporting that's done by whoever is willing and able to provide them with the information. But it really is, who's the provider, and it can be simplified by just doing it with one entity. Another real common question that comes up is in regards to penalties for ESS reporting. And look, I must admit here, I'd love to hear any experience from anyone in the audience. I'm not expecting anyone to come off mute. Would love you to, but if you wanted to otherwise, just put any comments in the chat or in the Q&A. But Yeah, penalties can apply to employee share scheme reporting, but based on my experience, so I'd love to hear from others, I haven't seen any penalties being imposed by the tax office. But if they were to, I mean, what would be within their armory to sort of to throw at companies who fail to report? Well, it basically would be like the failure to lodge on time, the failure to make a statement penalty. So they're the ones which are like $330 per unit, which get multiplied up to a maximum of 5 units. But then it depends on the actual size of the entity. There's different amounts that get multiplied for medium, large, and then significant global entities. Those maximum penalties get multiplied by up to 500, which could actually mean that one of those failure to lodge penalties could be as much as I think $825,000 for failure to lodge an ESS annual report on time, or to failure to provide statement to an employee. So, they can be very significant penalties that could be imposed for failure to meet the employee share scheme reporting requirements. Again, based on my experience, and I'll ask Dee shortly, but I'm still yet to sort of see any company that has been imposed any penalties for failure to provide ESS reporting to their employees or failure to do it on time. I think that the ATO are reasonably understanding that it is a challenging requirement, but they are the penalties that are available to companies. I mean, I might just pause there. Dee, again, I don't know what your experience is around penalties, or if there's anything to share on that.
Yeah, I haven't seen one either, so which is good news. But what I would probably add is if any issuer is having challenges in getting their ESS report organized based on they're still waiting for data from overseas and for various reasons, you can notify the ATO that there will be a delay or you want to get an extension for the late lodgement of the data. And most of the times, the ATO, as long as they are notified of that, they would provide an extension. It could be an additional month or 2 months so that you can finalize your reporting.
Thanks, Dee. The next common question or area around common questions are amendments. And so you can amend employee share scheme reporting as many times as you want. So there's no limit. And I've been involved in circumstances where we've had to amend a particular annual report, several times. And in fact, going back to what Dee was talking about earlier with indeterminate rights, they can also be a thing that requires ESS annual reports to be amended on multiple occasions. Essentially, there is the need to amend ESS reporting anytime there is a material change or omission that the employer becomes aware of. A couple of examples I think that that do trigger lots of questions from clients. Again, one may be around mobile employees. Again, it might be a circumstance where the employer has reported gross, and then the employee is then coming back saying, well, really, I'm only taxable on a portion. I think that would probably be a circumstance where you could probably try to push back to the employee to sort of say, well, look, we've reported gross as we're allowed to do, and you may have determined that there's a lesser amount, the assessable amount to be reported on your tax return, that you can make that adjustment yourself in your tax return. The other one that really comes up a lot though is the 30-day rule, and that's where Dee mentioned that where the taxing point may typically be at, say, vesting or exercise. If the employee actually sells those shares acquired on vesting or exercise within 30 days of that time, then the taxing point shifts to that date, and therefore technically that should be the date that the company reports on. This is a challenging one. The actual legislation in the Taxation Administration Act around employee share scheme reporting actually says that companies can disregard the 30-day rule if they're not aware of those sales. either at the time of the event or by the time that they do the ESS reporting. But we do find lots of circumstances where companies may report on the basis of ignoring the 30-day rule because that information isn't easily available to them. I find this again particularly the case for foreign issuers. But then you might find an employee that comes back to the company and sort of argues, well, look, I did sell my shares within 30 days. It's a different price. It's a different value. It's a different date. Can you update the reporting? And the the challenge there is what do companies do? Do they amend the reporting, which can often be a costly process as well to do, or do they sort of try to make agreement with the employee that they just report a different amount in their tax return? It's not really sort of a real clear one because again the company can sort of argue that if they're not aware of that information that they under the legislation that they weren't required to consider the 30-day rule because it wasn't available to them. But then you also have this provision that talks about material changes or revisions, and when they do become aware that you are required to report to amend the ESS reporting. So that can be a challenging one to deal with, and I think it's largely ends up becoming a depending on how difficult or the employee is or how willing you can get them to sort of to go on and deal with it via their tax return. The last one that I've got there is, and Dee touched on this, and this is a common question around like who can sign off on the ESS reporting, particularly because at the bottom of the ESS statement there, it's got an authorised signature. And this certainly isn't anything that's dictated by the tax rules. It's really something that each company needs to have regard to based on their internal processes and their internal authorizations. Essentially, it is anyone within the company who is authorized to sign off on such documents. So it's not really a tax legislative question. It's really then more a company process around who actually within that company is authorized to sign off. Dee, any other common questions or any further insights on any of those particular categories?
Yeah, I think, Marc, this is a question around the 30-day sale that comes up quite often. So where an employee sells their shares independently, it's not always visible that they have sold the shares. In that case, it is easier for an employee to complete or update their tax return with the values. Ultimately, the information that is being supplied to the ATO it's information for the employees to then confirm and agree to. So the employees certainly have the ability to amend that based on the 30-day sale. And I'm thinking more from an issuer perspective here, that it is easier for an employee to make that change rather than do a whole amendment run to the ATO report.
Thanks, Dee. And so just touching on then who can help prepare and lodge employee share scheme reporting. Well, clearly, share plan administrators can, and particularly all of the various share plan administrators here in Australia, one of which Dee is a representative from, are obviously fully geared up to help prepare employee share scheme statements and lodge ESS annual reports. I think particularly obviously with the clients that they're servicing, but also others. And then we can also have other providers that have developed software that meets the ATO's specifications to lodge that with the tax office. And my experience would be that most professional services firms and payroll providers have developed software that meets those specifications and can definitely assist. My experience probably been on the payroll providers is that while they do have that software, they probably may not necessarily have any of the experience or guidance to be able to help companies that to do that. So generally, I think if you are using a payroll provider, you need to be pretty much aware of what your requirements and obligations are yourself to ensure that you complete that filing accurately. And then there also is an option that I must admit I'm not very familiar with, but you can use, via the ATO's ESS online form, I think, which can basically be lodged via the business portal. There is a few, I guess, limitations of that. I think it can only be used for up to 50 employees. You can only enter up to three scheme types, so almost like 3 transactions per employee. And this particular online form doesn't generate the employee share scheme statements for you. Like, it just is doing the annual report submission to the ATO. So you also would need to sort of separately produce the ESS statements yourself, via the pro forma PDF that the ATO provides. But they're essentially, I guess, the 3 main ways that companies can satisfy and prepare their employee share scheme reporting. I think as we sort of start to come towards the end, like how to prepare for success for employee share scheme reporting, I think probably one of our top tips, I'm sure probably Dee would agree with me here, is to start early. We're at the very end of May now. If you haven't already started, for sure, get started now. Don't leave it to the last minute. I think actually many companies actually have already made a good start on their employee share scheme reporting, by now. Because there's very limited time, from the end of the tax year in which statements need to be provided to employees 14 days later, and so lots of that work needs to be done now. Getting the data, validating it. I think the second point there, and we've touched on this before, is again having a clear understanding around what those relevant taxing points are. ESS reporting requires the reporting of taxing events to employees in the tax office, so make sure you're reporting the correct taxing point. Ensure that you've got that reportable population correct, and we've spoken just earlier around mobile employees and terminated employees that can be sort of particularly difficult or can be missed. So make sure you do get that reportable population as complete and accurate as possible. Thinking about if there have been any sort of special events that may have occurred, during the year or during the years in which you may have to do reporting. I think, again, around stock splits or takeovers or any kind of acquisitions, and how that may sort of impact on the reporting, or who's required to do the reporting, or if it's an amended reporting for a prior year, does any of that sort of information need to be adjusted for doing prior year reportings? And then the last one there around sort of preparing for success is to have some really good communications, with your employees. That statement that Dee showed up at the beginning of the presentation around the pro forma ESS statement. Look, it's very generic. It doesn't really contain a whole lot of information. Employees will typically have questions around, what are the transactions that have amounted to that number that appears on it? What positions has the company adopted in reporting that amount? What exchange rate have they used? What share price have they used? Various matters that I think are really important to communicate to employees. I guess Andrew mentioned, it is an opportunity to also to engage with your employees around, it's been a great year. This is the amount of money that you've made sort of out of your participation in this employee equity programs. So think about how you can sort of communicate with your employees, share with them information around the tax treatment, because obviously it is a tax requirement. There's going to lead to lots of questions around what this means from a tax perspective. So any kind of supporting information, covering letters, supporting calculations, separate taxation summaries, or even webinars for employees can really help to clear up any misunderstanding or concerns that employees may have, and therefore sort of reduce some queries in the back end. I mean, Dee, I don't know, again, from your perspective, anything else there on how companies can sort of prepare for success?
No, I mean, I think this is absolutely spot on, Mark, because you starting early is a key to making sure you're picking up the right employees, transactions that need to be reported, checking for any missing information around text file numbers or international assignees. You need to calculate the number of days they are in Australia or overseas. So the earlier everyone starts looking at that data, the easier it gets when it's time to actually lodge and provide employees those statements by 14th of July. So um, you know, we would recommend, it's end of May, but we certainly say start from mid-April onwards and start collating all that data for reporting for the financial year.
Thanks, Dee. And I think this is kind of our final slide before we sort of get onto sort of maybe any of the questions. I'm not sure, Andrew, if there's been many that have come through, but probably also when communicating with employees, like these are some things that you might want to sort of think about. Communicating other positions that the company has adopted in preparing the ESS statements. So one there is around like what market value have you used? I know that many clients, I think Dee's mentioned to me, most of their clients via the share registries will probably use a 5-day volume weighted average share price. Many others may choose to use a closing share price on that particular day. Like they're probably the most common methods, but again, communicate like how you've determined market value at the taxing point. For any of those foreign issuers, like what exchange rate has been used. I think again, most commonly probably the RBA exchange rates are used, but that's something very much to think about. Insiders, again, will you be considering any sort of restrictions that apply post vesting for any of your insiders that may defer the taxing point and therefore the reporting point? And then we've talked about the application of the 30-day rule and mobile employees. They are again things that you can detail in your communication to employees around what position has been adopted. I just remembered, I think I may have gone one slide too early there for you, Andrew, to open up for the Q&A. But I think that the last matter there that I think that Dee and I wanted to really touch on was payroll tax. Although it's a separate obligation and requirement from employee share scheme reporting, really don't forget whoever's in your organisation is responsible for payroll tax. It probably is someone within the payroll team or maybe within the tax team. To that employee share scheme reporting income needs to be included in your annual payroll tax reconciliation. It is really a highly audited item by the state revenue authorities. We spoke before, we haven't seen much penalties or things or activity by the ATO on employee share scheme reporting. Well, I can guarantee you that's not the case on the payroll tax side. They take the information from employee share scheme reporting and they data match that against companies' disclosures in their annual payroll tax reconciliation. And just to make life a little bit tricky and keep us all on our toes, unfortunately, the rules for payroll tax purposes aren't exactly the same as they are in determining the values under employee share scheme reporting. So there can be some differences. That can also sometimes lead to some opportunities. But I think just one of the key messages here is don't forget payroll tax on your employee share scheme income. If that's sort of something that you're interested in learning a bit more about, please let us know, put something there maybe in the chat, and we could also think about maybe conducting a sort of separate session just around the payroll tax if that is something that's of interest. Dee, before I pass then to Andrew, sort of any kind of other final comments there just on the payroll tax or communications or?
No, thank you, Mark. I think that's great. This is a great reminder for everyone to make sure that ESS reporting or transactions are included in payroll tax, and to just double check with your payroll or tax manager that has been done in the past. If not, it's the time is now to get that organized and reported to various state revenue offices.
Thanks, Dee.
Thanks,
All right.
guys.
Well, I think with that we'll turn it to you, Andrew.
Yeah, I guess a couple of questions. If you had a magic wand, yeah, there are ambiguities and there are challenges in the reporting system we've got at the moment. Yeah, what would be the changes that you'd like to see in the reporting system to improve it? And I guess I'm conscious and that with the benefit of listening to this, in a sense, our assessment regime is so fact specific that it is not possible or realistic to generate perfection in a reporting system that would require perfect knowledge of the individual circumstances. But at the same time, we have a reporting system which is the genesis, and you mentioned data matching in terms of payroll tax, but a genesis for data matching, and there are differences. So are there things that you look at from what you've seen that you'd want to change?
Marc, you want to go first, or I mean,
Well, I'll look. I'm happy to go first. And this is probably controversial. Yeah, Andrew. I think we may have discussed this. I don't know if we're on the same page on this. And I think some other, but I know there are some companies that are, probably some that aren't. But I think, to be honest, a lot of the complexity with the reporting goes along because we don't have a withholding regime. And although that would kind of, I guess open up potentially a different can of worms or a different level of compliance, um, if we actually did have a withholding regime on employee equity awards, which applies in, I'd say, 95% of countries around the world, I think it actually would simplify a lot of the process, and arguably you might not even need a reporting process, anymore at all. And I do actually think it actually would be better from an employee experience perspective, because rather than leaving tax to be dealt with well down the line when employees have forgotten about it, part of the onus actually becomes on companies to help employees, just like companies do with salary and wages, in deducting it in a timely manner. And I think then taxes are often taken off the table. So look, that might not be there might be a bit more of an extreme answer to your question, but that's how I would actually look at making the improvement. Do
I agree with you, Marc. I think just having a bit more standardization around the reporting regime, and given a lot of the organized companies in Australia are global entities or global employee base, do face this challenge of having different ways of reporting their data. So that's one. And the other thing that I can think of, and this is probably again, we see it quite often from a administrator perspective, is where the awards are being granted to an associate rather than the employee directly themselves. And whilst the laws allow for that to happen, the tax is still on the employee. So it does create a bit of a disconnect between the holder of those rights, shares, or the awards of the plan. But then when it's time to actually do the ATO reporting, it's still on the employee. And quite often employees do not understand that, oh, why am I paying tax on it when it's held by my self-managed super fund or a family trust? So having a clarity or a bit more streamlined process in that case would certainly make it easier for the end users and for the reporting entities as well. I'm sure, Andrew, there's more, but let's just keep it simple today.
I guess the other question I had with you is, or it's a sort of question, but an editorial observation, was with the benefit of listening to this discussion would have been fantastic. There's a lot of information that goes into this process, that goes into the reporting process. And I'm just interested in your observations around, in a sense, the integration of the data collection. I mean, Marc, you alluded to it around mobility days in Australia or days working for particular employees. and connecting those data points and making sure that you've got systems in place that mean that we don't have that mad flurry with an Excel spreadsheet on the second last day before reporting, trying to work it out. I mean, have you seen people who do that well?
Yeah, I think that there definitely are. You know, I think particularly those organisations that are probably global. They've got withholding and point in time reporting obligations to have to do that in various countries around the world. Actually, probably do that well. I think it's probably those that struggle that really don't come to consider it until they actually come to the back end, to the time of doing the reporting, that struggle with it more.
I'm conscious of time. Thank you today, and thank you for our audience being with us. I would encourage anyone and all of our audience, whether listening to it live or after the event, if they have an interest in any of the topics that have come out of this, or indeed any reform topic, please raise it with us. I guess, to be pragmatic, we can only advocate for what we know people are worried about, and the more we hear and know, I think the better job that we can do for you as a community. So please engage with us and help us help you. So thank you, Marc. Thank you, Dee, for your time today, and thank you for our audience and taking time out on the last day of the month.
Thank you, Andrew.
Wonderful.
Thank you, everyone.
Thank you.
Bye-bye.